Hello everyone, I am Atika and I'm going to talk to you about course MB 2203 Financial Management. We still continue to talk about cash flows and financial planning, but now we reach the last part. We will talk about proforma statements. Proforma statements are the projected or forecasted of financial statements. On this session, we will talk about preparing proforma income statements and proforma balance sheets. The inputs to develop proforma statements are financial statements from the preceding year or from previous year, the sales forecast for the coming year, and also the cash assumptions about number of factors. So we need 3 inputs to make our proforma financial statements. So let's begin with sales forecast. So for sales forecast, we need to predict or forecasting the sales of our products or services. For example, here we have product A and also product B. And the unit sales for each product, we already knew. For product A, around 1500 and product B, 2500. And the sales for the product A and product B, we get from the unit sales, multiplied by price per unit. Then we get the sales for each unit. For example, here, product A, the sales in total is 15 million rupiah, and product B is 50 million rupiah. So in total, we have the sales forecast for the next period around 65 million rupiah. Now, after sales forecast, we continue to preparing the proforma income statements. The method for developing a proforma income statement is we can use the percentage of sales method, which is the method start with the sales forecast and expresses the cost of goods sold, operating expense, interest expense, and other accounts as a percentage of projected sales. How to make it? Let's jump to the example here. We have Samsung income statement for year ending December 2020. So we have the financial statements here starting from the sales revenue until the earning available for common stockholders. So we calculate the cost of goods sold with the sales divided by sales to find the percentage of cost of goods sold to the sales. We find here 63.3%. And for the operating expense, we do the same. Operating expense divided by sales, we have here 20.5%. And interest expense, we also need to divide interest expense with the sales, so we have here 3.8%. After that, we can make the proforma income statement for 2021. Here it is still the percentage of sales for COGS, total operating expense, and the interest expense. So now we can make the proforma income statements. We start with sales revenue that we already had in the first step. And then for COGS, we have to multiply the 63.3% with sales revenue in 2021. Here we have around 41 million rupiah. Sales minus COGS, we have gross profit. So for the operating expense, we have to multiply the 20.5% with the sales revenue. So we have here the total operating expense as 13 million rupiah, around 13 million rupiah. And gross profit minus total operating expense, we have the operating profit around 10 million rupiah. Next, interest expense, we also have to multiply the percentage of interest expense to sales around 3.8% times 65 million rupiah. So we have the interest expense around 2.5 million rupiah. Operating profit minus interest expense, we have net profit before tax. We have to deduct the taxes, and we have the last part as net profit after tax. Next, how to preparing the pro forma balance sheet. Method for developing a pro forma balance sheet is using the judgmental approach. It is the simplified approach for preparing the pro forma balance sheet, under which the firm estimates the value of certain balance sheet accounts and uses internal financing as a balancing. To apply this method, a number of simplifying assumptions must be made. That is why we need three inputs that we have mentioned in the beginning. So let's see this example, the pro forma balance sheet for year ending 2020. Let's say there is a changes in cash around 75 million rupiah, and changes in account receivable and also the inventories. Another changes also happen in machinery. So the total asset in around 381 million rupiah. So if there is no changes in liabilities and also the equity, then the assets and the total liabilities and equity will not be balanced, right? So that is why we need to put the external financing required here in the equity. So by that, the total asset is equal to the total liabilities and stockholders' equity. So let's see the evaluation of pro forma statements. There is a weaknesses in pro forma statements such as past financial performance will be replicated in the future because we use the past or the historical financial statements are our baseline, and also certain variables can be forced to take on certain desired values. It might be happen from our assumptions or also from our sales forecast because we have our own judgmental and also our assumptions. And also the assumptions cannot be justified because it's based on our subjective point of view. So analysts must understand how to use them to make financial decisions. So as an analyst, you have to remember that this financial statement is the projected or the forecasted financial statements. It is not the real financial statements of your firm, of your company. That's all for this session. I hope you learned a lot and find something useful for you from this course. I will see you soon for the next part. Bye!